be one of the things he talks about, and that's the two sides of the coin, right? How well are we going to do, and will inflation be persistent? Let me give you a little bit of Dr. Ed's background. He's the president of Yardeni Research and a provider of global investment strategies and asset allocation analysis and recommendations. He previously served as the chief investment strategist of Oak Associates, Prudential Equity Group, and Deutsche Bank's U.S. Equities Division in New York City. He was also the chief economist of C.J. Lawrence, Prudential-based Securities, and E.F. Hutton. He taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve of New York. He's held positions at the Federal Reserve Board of Governors and the U.S. Treasury Department in Washington, D.C. Dr. Ed earned his PhD in economics from Yale University in 1976, having completed his doctoral dissertation under Nobel laureate James Tobin. And previously, he received his master's degree in international relations from Yale University. He completed his undergraduate studies magna cum laude at Cornell University. He's frequently quoted in the financial press, including Wall Street Journal, Financial Times, New York Times, Washington Post, and Barron's, and was dubbed Wall Street Seer in a Barron's cover story. He appears frequently on CNBC, Bloomberg Television, Fox Business News. He also has a media blog that is well worth following. In 2018, Dr. Ed published Predicting the Markets, a professional autobiography, which is rated 4.2 on Amazon. And in this book, he shares his unique insights into predicting the trends and cycles in the domestic and global economies and financial markets, including stocks, bonds, commodities, and currencies, based on his first 40 years on Wall Street. In 2020, he published Fed Watching for Fun and Profit, which is also rated 4.2. In this guide, Dr. Ed, one of the world's most experienced and widely followed Fed watchers, helps investors understand the FOMC's decision-making process, anticipates its moves, and profit from those insights. Dr. Ed is also LinkedIn's 2019 Top Voices on the Economy and Finance, and you can sign up for his complimentary trial of his research, and it's something we use every day. It's the first thing I read. Fortunately, Ed's put it out at night, so I get it early release. And with that, Ed, I'll turn it over to you. And just before we start, if you have questions and you're on Zoom, please put them in the chat. For audio purposes, we want to make sure we get the questions right and keep it moving. And Ed's going to speak for a few minutes, and then we'll take questions after. So, Ed, thank you.
Thank you. Steve, is the audio okay? You hear me without an echo and everything's nice and clean? Video's all right? Good. It's nice to know. All right. Well, Steve and Mark, thank you for inviting me to join your conference. I appreciate the opportunity. It's also nice to be back in Ohio. I grew up in Cleveland, Ohio, went to elementary school there, and then my folks decided to move on to California. Then between 2004 and 2006, I worked with Jim Olschlager over in Oak Associates in Akron, Ohio, and that was my one experience on the buy side. I've been on the sell side all of my career, but a couple of years with Oak. So I feel your pain sometimes when the markets aren't going in our favor. Appreciate the difficulty of the job you folks who are investment managers do for your different account bases. Well, let's get into it. I think that it's pretty clear to me that since the beginning of last year, we've been in a world war against a virus. In all wars, especially ones of this magnitude, there tend to be more than one front. And in this case, we've got three fronts. We have the health front, we have the financial front, and we have the economic front. And we've made a lot of progress in all three. The health front, we still have, obviously the pandemic isn't over. Our initial reaction was to lock down the economy. It might have kept quite a few people from getting sick, but we all got sick with cabin fever in March and April of last year. And once the lockdown restrictions were eased, we saw that the pandemic stayed with us. There was another wave last summer, and then the first wave really was the one that started basically in February, and I think for all practical purposes, it lasted through the spring. Then we had one that really hit us hardest at the end of last year and early this year. And now we've got a third wave that seems to be cresting when you look at the positive cases. Let's go and look at some charts here, which will make it easier to kind of sort through some of these concepts. So here we go. Here's the waves. As you can see, we had, I would say this is sort of the first wave. This is the second wave. And now we're in the third wave, and it seems to be cresting, which is great. Of course, the vaccines were produced in remarkable short order by historical standards, and people are getting vaccinated. And to the extent that that's happening, that should help to get us past this pandemic. Then again, we are sort of learning to live with this virus the way we live with the flu and other viruses. So it may never be over, but in terms of its impact on the economy, I think we've learned that the obvious, and that is if you lock down an economy, you get a terrible recession, which is what you see here in real GDP. Real GDP fell dramatically. It was a terrible, terrible recession, but it only lasted 2 months. It was March and April during the lockdowns, and that had an impact in making the official recession the first quarter and the second quarter. Then we had a remarkable recovery. Within about 12 months, we saw the economy completely recover in real GDP terms back to where it had been before the pandemic. And now I think we're settling down to sort of going back to the trend. So I do think the economy is slowing down to growth rates of 3 to 4% in the second half of the year. Some people are concerned that we may be losing the consumer, but we're really not losing the consumer. What we're seeing is that a lot of demand for goods, pent-up demand for goods, was satisfied during the in the months after the lockdown was lifted, and so we are seeing some weakness in retail sales because they rose to all-time record highs in the middle of the recession and in the middle of the recovery, and now we're sort of paying the price for that. That left inventory is extremely lean, especially among retailers. And so I do think we're going to see some inventory rebuilding. Some companies might actually welcome some slowdown in their sales to the extent that they didn't really like telling people, sorry, we can't meet your needs right away. It'll be a 3-month wait. To the extent that things slow down, we should see less of that. We should see an opportunity for inventory rebuilding, and that'll be a source of economic growth. So will capital spending. Capital spending has been on fire. We had some data today on non-defense capital goods orders, very, very strong. It's clear that companies are continuing to spend quite a bit on expanding and improving the efficiency of their capacity. And a good chunk of that is in technology, and we'll get to the impact on the economy of that in a minute. So here we have personal income versus personal income excluding government support. So without government support, you can see that personal income took a big dive during the recession. However, the checks were so large that the government sent, the fiscal response was so awesome, unusually awesome, nothing even close to it, for example, during the great financial crisis, that personal income actually went up in a recession. And then it went up again with the checks. I think now we sort of get back to the trend of personal income growth, and it will be slower than the recovery numbers that we had seen. I mentioned the consumer, the importance of the consumer. One of the ways to relieve cabin fever once the lockdowns were over is to go shopping. It releases dopamine and makes us feel good. In May, early May, it was spring, and we were here locked up in the house with some family members and a few dogs. And once the lockdowns were lifted, we gradually started going out. My wife went to a garden center in early May, bought a patio set so we could at least enjoy the fresh air in the backyard and have some meals together. And the salesperson said it's the last patio set they had in stock because demand for anything outdoors just absolutely exploded. And so you can see that in the personal income data here. Personal consumption absolutely soared to new highs in the face of this pandemic. Services was held back by social distancing restrictions, but it's made a good comeback. And all in all, consumption is at a record high, which is again quite impressive. Also helping the recovery was what happened in housing. We had a dramatic drop in housing activity during the pandemic, during this pandemic lockdowns. Then when they were lifted, we saw a tremendous change of mind here. A lot of people said, well, maybe I don't want to rent in the city. Maybe this house is too small. I need something bigger that's got an office, maybe something with a swimming pool in the back for the kids. And so we had this tremendous increase. That led to a tremendous increase in home prices, 20%, and priced a lot of first-time would-be buyers out of the market. And so now I think we're sort of paying the price for that. But the reality is there, we know there's shortages of everything. There's also shortages of inventory in the housing market. So that probably has some importance in terms of rent inflation and the CPI and the consumption deflator. I think we are going to see rent inflation making a comeback. So that's something to consider when we discuss inflation. The good news is that the pandemic accelerated the pace at which companies have been implementing plans to incorporate all sorts of technologies into their operations. And to a large extent, a lot of companies had to do it very, very quickly, but it certainly made us realize that technology is a very important component of how we do business. And then as the pandemic wore on, but without the lockdowns, and business started to really improve a lot for a lot of different kinds of businesses, we started to realize there's also a shortage of labor. And that shortage of labor, people have come up with all sorts of explanations. There isn't necessarily any one unique explanation, but it does make sense that the $300 per week of federal support might have encouraged some people not to go looking for work, but to stay unemployed and collect those benefits. Those came to an end on September 6th. So in the next month or two, we'll get some indication of whether employment is picking up. We know that there's a record number of jobs out there, over 10 million. And so, and that well exceeds the number of unemployed. So that's one possibility. Another is that childcare and elder care support has been very difficult and very expensive. Now the government just came up with a increase in the child care child tax credit. Maybe that'll provide some money for people for child care. But also a lot of people in that industry have dropped out. So it's hard to find people, again, labor shortages in that area. So I think that the underlying reason for this labor shortage is demography. The labor force isn't growing very rapidly because the population, especially the working age population, isn't growing very rapidly. We did actually have some support for the labor force in baby boomers like myself working beyond the traditional retirement age of 65. But maybe with the pandemic, some of them thought about the meaning of life and what they wanted to do in the future. And some of them may have just said, you know what, it's time to retire. Let's go travel. Let's do something else. Then again, baby boomers are aging like everybody else. And so we may see more and more of the baby boomers retiring. But the pace at which we're replacing them with younger people is about even. As a matter of fact, the labor force, 16 years or older, is only growing like 0.5% right now. So I think we started to get a glimpse of the labor shortages before the pandemic. The unemployment rate got to 3.5% down in early 2020. So I think now there's an increasing recognition that maybe these labor shortages are chronic, that they're going to be with us for a long time, and that businesses have to use technology to augment, not to replace. Workers are not replaceable. Everybody's hugging them and trying to make them feel good and trying to encourage them to stay and not go somewhere else or quit and move to another career. So there's a tremendous appreciation of the need to keep your workers and make them happy. And of course, some of that has to do with raising their wages, providing them with tuition support, and so on. And we know that big companies like Amazon and Walmart JP Morgan are all doing those kind of things. And nevertheless, businesses realize that if they can't get more workers and they got to work hard to keep their workers, they at least have to pay them more. They have no choice but to augment their productivity, their mental and physical productivity. And today we have the technologies that we've never had before that can do both. In the past, a lot of technologies really augmented the physical productivity of workers. Arguably, the tech revolution of the 1990s helped on the mental productivity of workers. But most of that technology, the big clunky PCs sitting on desks with software that had to be manually rebooted, they were really good at word processing. So they replaced electric typewriters, and they were pretty good at Excel spreadsheets. And if you had businesses that needed that kind of technology, it certainly improved your productivity. But it wasn't a broad-based technological revolution that affected and could be used by all businesses. In 2006, Amazon introduced the Amazon Cloud. We've been on the cloud since 2011. My company has been virtual since 2007. So welcome to my world. We have thousands of charts that are automatically updated by our system, which sends a message on I think every second to our data vendors. Anything new, any data that we use, let us know if there's an update. If there is, a system brings it right in, updates these kind of charts that you're looking at, and puts them in the proper chart book and loads them up on the website. So it is kind of an artificial intelligence system, if you will, crude, but it's been great for us. So we kind of view Yardeni Research as a tech company. We obviously, our bread and butter is providing strategy and economic insights to institutional investors, but in many ways, we couldn't do what we're doing without being a tech company. So as investors, I strongly recommend that whatever you have in your portfolios, look at it. And if they're not tech companies, maybe you want to get rid of them. And by that, I don't mean they have to actually make technology. They can also use technology. Companies have to use technology to increase their efficiency, the way they do things. If they don't do it, their competitors will do it and put them out of business. So I think that we could be in the early stages of the roaring 2020s. In the 1920s, we know there's tremendous technological innovations that increased productivity, standard of living increased dramatically. Stock market obviously did very well. I'm not going to tell you that the stock market still has 1920s roaring environment ahead of it. I think we've roared quite a bit, and I think from here on, we're more likely to increase at the same pace as earnings, which should be about 6 to 8%. The stock market has doubled from March 23rd through August 16th of this year. I will guarantee you it will not double again in the next 12 to 18 months. But the background for the market, for earnings, for economic growth should be quite good if I'm right about productivity. So take a look here at figure 8. I have to wet my whistle. I hope you're not hearing the lawnmower in the background. Forgot the gardener decided that Mondays is a good time to come here. I always liked it better when it was Fridays, but let me know if there's, I guess right now he's quiet. So productivity, let's look at the red line. Now, bear with me here. What I'm doing here is taking the 20-quarter% change, the 5-year percent change at an annual rate in productivity, just to smooth it out and to get the underlying trends, both cyclical and secular. Well, there really isn't any secular trend in a growth rate of productivity, but certainly is cyclical. And what you can see is that there's a productivity boom here in the 40s and 50s. It's the red line, remember? There's another productivity boom here in the 60s. There was a productivity bust in the mid-60s to the early 1980s. Minor little productivity boom here. And then a big boom here. Again, those are the clunky PCs with Microsoft and other sorts of softwares. It was great, but it wasn't a big booster for productivity, other than in some industries. Then we had the productivity growth rate come down a lot, and we bottomed here at the end of 2005, and we're already up at 2%. So we're already in a productivity boom, if you will. And when I tell people that productivity could jump to 4 to 4.5% on a 5-year trailing basis over the rest of this decade, or second half of the decade at least, they unless they see this chart, they say it's impossible. No way that's possible. But you can see that previous productivity booms have in fact been around the 3.5 to 4.5 range. And I think the technology revolution that we're in now has the potential to at least match that, if not actually exceed that. I mean, you can't get a better story than that for the economic outlook. If productivity makes that kind of comeback, it's great for hourly compensation, for purchasing power, for real pay per worker. And that's very important, because if we don't have growth in the labor force, we're not going to have much growth in consumer spending, unless the consumers are getting significant increases in their wages relative to prices. If they get big increases in wages and prices completely match those or exceed it, then they're not going to do well at all. It's going to be a wage price spiral, which is the 70s scenario. So the alternative to the roaring 2020 scenario is in fact the great inflation of the 1970s. What are the chances that that could happen? Well, you can put your own subjective probabilities to these two scenarios. Right now, I'm saying 65% for the roaring 2020s with productivity making a comeback, and then 35% for the great inflation of the 2020s, kind of similar to this. Now, again, one of the huge differences between what I think is ahead of us in the red line here and what happened back here is that here productivity collapsed. Now, right around the late 70s, I joined the labor market as a baby boomer. Baby boomers started to stream into the labor force in the 70s, and the growth rate of the population was of the labor force population was about 2.5 to 3%. So there's lots of labor force growth, a lot of baby boomers coming in, participation rate of baby boom women in the labor force increased, smart people, well-educated, but inexperienced and not that productive, but they were relatively cheap. That was one of the reasons that productivity came down. There were plenty of others. There were cost of living adjustments in labor contracts, including productivity clauses where they automatically got increases no matter what productivity was doing. But for whatever reasons, I think there's also a lot of bad luck. Nixon decided to take us off the gold window in the early 70s. So the dollar took a dive, commodity prices soared, oil prices soared, food prices soared. Everything that could go wrong kind of went wrong in the 70s. Now, it's conceivable that we'll have bad luck again this time, in addition to bad policymaking. So what could go wrong? Well, let's watch commodity prices very closely. I think that China's problems may actually be an important development here in keeping a lid on inflation, particularly commodity prices. So we'll see how that plays out, but I am watching commodity prices very, very closely. The wage market is very important, just the way it was in the 70s, but in the 70s, we had a wage price spiral. Any big increase in gasoline prices, in food prices, went straight into wages of labor unions with cost of living adjustments. We don't have that now, but we certainly have a tremendous labor shortage, where only a year ago, there was a debate on whether companies should pay a living wage of $15 an hour. And there was a lot of resistance by businesses to that. And here we are a year later with the labor market this tight, and suddenly $15 an hour seems to be the market price for labor. But again, if you want to go out of business, raise wages and don't increase productivity. If you have to pay your workers more, you have to increase their productivity. So those are the two alternative scenarios. That also leads me to put some probabilities on inflation. Is inflation going to be transitory, the way Fed Chair Powell thinks? I just came up with a title for my piece I think tomorrow or the next day, called "Is Powell Transitory?" In other words, will he be reappointed? I'm not so sure he will be. But he's taken the position that there's this base effect on inflation, and that the problem with the base effect is it makes sense if you're doing year-over-year comparisons, March, April, May, June, July, but we're getting August, September data up ahead here, and if it doesn't show a significant improvement in wage inflation, I'm sorry, in price inflation, then I think the base effect story would lose some of its credibility. Now, in my roaring 2020s story with productivity making a huge comeback, productivity is what keeps inflation down and allows real wages to go up. So I guess I'm sympathetic to the transitory, but I'm thinking maybe a little bit more persistent, and we'll maybe looking at, I don't know, 3.5%, 4%, 4.5%, maybe even 5% inflation through the end of the year. And then by early next year, maybe we get down to 2.5% to 3%, and maybe we kind of lock that in the second half of next year. Big bet on productivity making a comeback, but it's not that big a bet because it's already been making a comeback, and I think the pandemic accelerated it. The other choice is the great inflation of the 70s. So to be consistent with my two scenarios, I would say that the chances that inflation will be transitory or a little persistent is 65%, the same as my roaring 2020 scenario. And the chances that inflation will be chronic, a real problem, creating maybe even a stagflationary environment, is something that would get a 35% probability. Having said all that, I am becoming somewhat concerned about some recent developments that we're seeing on the inflation front. I do think the base effect inflation will come down, but I do think that rent inflation will be going up. Home prices are up 20%. It's turned off a lot of would-be buyers. They're going back to their landlord, and the landlord is saying, fine, we'll come back, but there's been a rent increase. And I'm hearing that anecdotally more and more, and we're seeing some signs of that in the CPI numbers that are coming out. The other worrisome development is in the energy patch. And without taking a position one way or the other, or starting a fist fight over climate change, let me just say this: climate change activists have been very successful in getting us off our addiction to fossil fuel. We've seen them put a couple of board members on Exxon. That was a huge development, because it sends a message to other companies that if they don't toe the line on reducing their carbon footprint, that they are vulnerable to having new members on their board that aren't necessarily to their liking, or aren't going to necessarily like their current business model, and will put a lot of pressure on them to change anyways. So there is a lot of pressure on energy companies to stop drilling, to stop looking for product. That's fine if the transition is smooth between fossil fuels and renewable sources. But we're seeing a cautionary tale in Europe, where gas prices have soared. The shortages of gas is creating a real problem for the business environment there. And some of that has to do with the fact that there's less supply available. And the world seems to be getting a little competitive here in terms of LNG, and Japan wants it, Brazil wants it. So prices have gone up. That's inflationary. It's stagflationary to the extent that rising prices, especially shortages of fuel, make it harder to produce things. So it's something that I'm certainly aware of and watching carefully, watching natural gas prices. And the winter hasn't even started, so we'll see how that unfolds. But energy crises have in the past led recessions. I don't see a recession at this point, but it's something I'm concerned about. And that obviously goes into the concern about the great inflation of the 1970s. Let me briefly discuss China, then let's open it up for some discussion. Um, where we may actually get some relief, as I mentioned, is in commodity prices as China's economy is worn down by some of the issues that have become rather important. This is a chart of the trade-weighted dollar versus the Goldman Sachs commodity index is the blue line. And I think it's possible here that commodity prices are peaking because China's Evergrande's just the tip of the iceberg for the problems that China has with its property market. It's probably the biggest real estate bubble of all times. Chinese bank credit is up from $5 trillion in 2008 to $30 trillion now. It's never been anything quite like it. So they financed a great deal of their growth with credit. Of course, they have more control over their economy and their banks and their bankruptcy proceedings, and they're able to restructure things in a way that might be quicker and more efficient than we've seen in our system. But nevertheless, they do have a big property real estate bubble, and they do have a tremendous amount of credit overhang. It's credit crunches, sometimes combined with energy crisis, that cause recessions. So China could have a recession, which would be a shock over there. China could have falling home prices, which creates tremendous social instability. So the Communist Party there is going to do everything they can to manage a soft landing. But we'll see whether they're any better at it than we were back in 2008, 2009. So I think China's got problems. And by the way, China's problems relate to their demography. Everything they're doing relates to their demography. China, like everybody else that saw urbanization, saw a decline in their fertility rate. In agricultural economies, people need a lot of kids. They have an economic value. In an urban setting, kids are just expensive. They're all cost and no economic value, unless you expect them to take care of you in your old age. But there's certainly not an incentive to have a lot of kids, no place to put them in an urban environment. So fertility rates have declined everywhere around the world except India and Africa, because they haven't urbanized quite as quickly as everybody else, but they will. But certainly China has urbanized. Over 60% of their population now is in urban areas. Not much room to have kids and costly to have kids. And then because of the one-child policy, which was an absolute disaster, single people in their 20s and 30s have a social responsibility to take care of 2 senior parents. If they get married, they have a social responsibility to take care of 4 senior parents. If they have one kid, that kind of about as financially burdensome as they can possibly take. So they're not having more than 1 kid now. Now that the government wants them to have 2 kids, that was ruled back in 2016. Now they say they want them to have, well, actually it was 2015. They said, okay, no more 1 child, you're gonna have 2 children. Now this year they said, okay, you're gonna have 3 children. Now, again, everything that the Chinese Communist Party government, President Xi, has been doing recently, they've been kind of making people's heads spin, make absolutely a lot of sense in the context of they are desperate to get people to have more kids, to have babies, to increase the growth rate of their population, absolutely desperate. So they want to bring down the price of housing. They want to bring down the price of education. They want to level the playing field. They don't want rich people marking up the prices of education and housing. And again, be an interesting experiment to see if they can pull it off. But there's lots of reasons to believe that it's not going to be smooth, and it may be a soft landing, but it's a landing one way or the other, soft or hard. So Steve, with that, why don't we open it up for some discussion? In terms of the stock market, I'm still bullish. I'm still looking for something like 5,200 in the S&P 500 by the end of next year or earlier. Then maybe something like 5,500 by the end of 2023. I don't see a recession in the U.S. I don't see a credit crunch, but again, nothing in life comes with no risks, and that's why I'm putting subjective probabilities on these kind of scenarios. The bond yield is finally making some sense here now that the Fed seems to be moving towards tapering starting in November. The bond yield's risen to 1.5, probably going to retest 1.77, and I think we'll probably see it at 2% by year end. Not exactly the end of the world, and kind of a vote of confidence in the performance of the economy, and also expressing obviously some concern about whether inflation really is all that transitory. In terms of the investment styles, I think you buy the market across the board. It's been pretty hard to do growth, value growth. They just seem to oscillate. Today's oscillation is with the backup in the bond yield. Value is in and growth is out. But I think a portfolio of technology, industrials, financials. I think energy could be a big home run in a world where climate change activists are succeeding in forcing companies to cut back on looking for supplies of energy. Go ahead, Steve. I'm not hearing you. Still not hearing you. I hope you heard me. Let me see. Let me change the speakers.
Thanks, Dr. Yardeni. I work for Trillion Clinic in Virginia. Followed your work since.
Actually, I have to mute myself to hear you, so I'm going to mute myself and go ahead and ask me the first question.
Thank you, Dr. Yardeni.
There it
Fred
is.
Greer. I work for Trillion Clinic. We are a health system in Virginia. I've been familiar with your work since 2000 when I entered the industry, and appreciate your insights. I have two questions. One you somewhat touched on. So over the pandemic, we've seen a focus on remote work, a focus on technological advancements. Do you see that as a backdrop that's going to support longer-term outperformance of growth investments versus value? And the second question, over the last 3 decades, we've seen a shrinking public market with more companies becoming private or staying private longer. As an effect, we've seen more money go into late-stage venture capital and growth equity. Do you see that trend persisting?
Well, with regards to remote work, I think it's here to stay, and I think it'll be a hybrid where some people who have the option of choosing to work just from home will do that, maybe coming in every now and then for meetings. We've been virtual since 2007, and for our business model, it's worked just fine. And we didn't even do it with video; we just did it with emails, quite honestly. And once a year, we'd meet for a nice lunch in New York City, but. I have 2 ladies that work from their apartments in New York City, and then we have a lady that works from Phoenix, Arizona, and Atlanta. We have a IT person in Denver. So when I've been doing Zoom calls over the past, well, since the beginning of the pandemic, sometimes the folks on the other end of the call will say, "Ed, before we start, could you tell us how you went virtual? How did you get your staff to buy into it? What software, what technologies did you have to incorporate?" And they asked me for about 5 minutes. And then I stopped them. I said, "Wait a second, you are virtual. Like it or not, you've gone virtual, and you're going to figure out ways to deal with it." And so I think there will be others. I mean, I actually, just by coincidence, and I'm sorry I couldn't stay longer, but just by coincidence, I was in Cincinnati last week, my first business trip, visiting accounts, and about half the people were in the office and half called in on Zoom, and the half that were in the office were very happy to be back, and the younger ones told me that they were particularly happy because they felt that they needed to be mentored, and they couldn't do that in a Zoom kind of situation. So I think it's going to be a hybrid model. Some companies may say, "Okay, we're paying too much rent for our headquarters in the city. We're going to have instead some hub offices in a couple of suburbs where most of our workers are, and you can have your meetings there and get together for lunch and so on. In terms of growth versus value, I'm not a big fan of that distinction. I much prefer sectors and industries, and especially in the kind of world that I'm suggesting, where technology is vitally important, not just for the companies that make the technology, but for the companies that use the technology. Again, I think everybody's a tech firm. I'm trying to hype myself up as a tech firm, just in case if there's any SPACs out there that are interested in Yardeni Research as a technology company, let me know. We can talk about it later. But I mean, value, a big chunk of value is financials, and there's such a thing now these days as fintech, right? In other words, financials are becoming very techy. There's medtech. The healthcare industry is becoming very, very techy. Trucking has been very techy for a long time. The truck is the device, and the logistics software run on the cloud is the technology that runs that whole tech system. Railroads have increased their profit margins dramatically over the years using technology innovations. So I would say that the market, I think, is going to continue to move higher on earnings. Earnings aren't going to go up 80 to 90% on a year-over-year basis the way they did in the second quarter again anytime soon. That's just a base effect that's coming out of a recession. And I think the likelihood is we're looking at profits of 6 to 8% growth. One of the things that's really impressive is profit margins. Profit margins for the S&P 500 all-time record high. My associate Joe Abbott and I were thinking, well, maybe that's because the S&P 500 has energy and materials companies. So those commodity prices go up, their margins go up. So just today or yesterday, time kind of fuzzes over when you write a daily. We came to the conclusion that if you take out energy and materials, you still have record highs in the rest of the S&P 500 in terms of margins. So that's very, very impressive. And I think companies since the financial crisis of 2008 have decided to manage for the margin. They've done a great job of increasing their margins. Trump's tax cuts obviously helped by about a percentage point in 2018. Biden's tax increases may take half a percentage point off of margins, but companies know this is coming, and they're going to continue to do what they can to increase their margins. They're going to have to work really hard at it because clearly costs are going up, whether we're talking about commodity costs, shortage of spare parts, labor costs, they're all going up. And companies know that they have to increase their productivity in order to stay in business in a world where these things, you have to deal with them as you have to deal with a hand you've been dealt, as they say in poker. In terms of private,
question that was called in, sent in from Rob Kalina, asking how closely to follow Tesla and the electric vehicle sector, and for how long?
I've followed a few Teslas on I-495, the Long Island freeway, but that's about it. So I don't have any insights for you on Tesla. We do on Thursdays do a piece on technological disruption. So we've done a lot of work on batteries and different kinds of technologies for batteries. The big problem with electric vehicles is you got to charge them up, and there's a lot more gas stations than there are charging stations, and it takes you really have to think ahead. So I think there's still a need to deal with the battery issue, and with the lithium, you still have some issue in terms of safety and in terms of environmental impact. But you're going to have to ask Kathy Wood about Tesla. I don't know much about the company itself.
Questions from the audience here? Yes.
Thank you. You raised a couple good questions for me when you talk about the energy prices increasing, and then now we're talking about electric vehicles. Seems that there's not a lot of conversation about improving the stability, reliability of our electric power grid in the United States, across states, not just for charging vehicles, but for this tech requirement, edge computing, as well as cloud. Where do you see the electric power grid improvements coming from?
Well, I guess we'll have to see. You never know what comes out of Washington. Even when all of us are focusing on the infrastructure bill, the two infrastructure bills, one good old-fashioned infrastructure, and the other one the Democrats like to think of as human infrastructure. But I'm trying to keep a pace of what they're doing and what's likely to come out. But apparently, my experience with this stuff is you never know until it's actually been passed and signed by the president. So I'll be very interested to see what's in the conventional infrastructure bill. I don't even really know how much it is. I've seen the press call it $1 trillion package, and then I've seen the press call it a $550 billion package, and some of it is a little bit hocus pocus. Apparently, it's more 550 billion than it is $1 trillion, but they're adding stuff that had already been in the pipeline, and so we're, I think, 8 years or something like that. So it's not like all going to be for one amazing year. And I would think that in that kind of bill, there'll be funds allocated to the infrastructure of our electric grid system. I mean, otherwise, what are we? We're kidding ourselves if we don't improve the electric grid system. But there are a lot of issues with renewable energy. As in the UK, they actually wanted to be done with fossil fuels by 2024. I mean, I was shocked to hear that was their ambition, and they've been building a lot of wind in the North Sea, and then once you know it, the wind died down, and so that's creating a bit of a kind of a hysterical need to find fossil fuels to make up for that when they can. So it's fine to talk about a transition, but to actually do it is a whole nother challenge.
Hello, this is Brian Starr. I work for Denso. It's a very large automotive company, smart mobility company. So maybe one comment, the grid is a very big issue. Maybe on the coast, everyone has a Tesla, but here in Columbus, Ohio, maybe only one person has a Tesla. When we have everyone with an EV coming from coal-fired plants, electric plants, we're not actually getting a net carbon gain there because that's how they're powered. But those issues are going to need to be solved in public-private partnerships, obviously. And the amps that you use to charge a Tesla aren't as much as you'd mine for Bitcoin. So that's probably the bigger issue. But yeah, that's a concern that automotive companies are thinking about because it kind of looks like we're just kind of running into this world of EVs and pushing the combustible engine behind because we have to, because there's government regulation. We have to have this kind of fleet available by a certain date. So we're kind of running toward, that's the technology that won for the time being. And there are concerns. The question I would have for the doctor here is about, when we talk about the energy issue, I'm a little worried. You use the term like pricing out the consumer. When we move to EVs, these cars are more expensive. We're not going to be at scale of a regular combustible engine for a decade, if not longer. Are we just kind of moving burden and money around and creating a different economic issue for people who 5 years from now still can't afford an EV, but there's a scarcity of gas because of the push that we've made? Like, do you guys do forecast? Do you see that as a problem?
Well, again, I'll give you those two scenarios. And the second scenario, the great inflation is got 35%. It's not, subjective. I'm not telling you it's not going to happen. It's not 5-10%. I'm constantly testing my scenario theories with information that I'm gathering, and it's a fairly new concept in my thinking about how running like mad into climate change into the climate change in terms of EVs, in terms of the electric power grid. It's like we're not doing this in a very well thought out manner. Now that really gets to the point of, are the governments going to actually manage to somehow get this transition right, or are they going to screw it up royally and just have a big political backlash against the Greens and all these efforts? We can either be exposed to insane hurricanes and insane wildfires, or we can freeze in the winter. It would be best if this thing were done in a way that made it a smooth transition. But I'm reading more and more stuff that suggests that Europe, what's going on in Europe, tells us it's not going to be smooth, and it's going to be painful, and it's going to particularly hurt lower income families who have to pay higher prices. And economists like to take food and energy out of consumer price indexes, but personally, I got a nice home here in Long Island, and we had to put in 2 1,000-gallon tanks for propane, and I can see what's going on with the cost of propane every month. I can see what's going on with electricity charges every month, and I can deal with it. But it's got to be horrible for a lot of low-income people to suddenly have their basic utility bills go up like this. In Europe, the government's saying, "Well, is the government going to subsidize all of our costs that we're all going to individually incur from this transition?" So it's worrisome. The Wall Street Journal last week had an interesting story about how commodity producers just aren't looking for commodities anymore because of the carbon footprint issue. And we're not talking about just oil and gas. We're talking about copper, aluminum. We're talking about the basic stuff. So I think we all have to be thinking about how's this transition going and how's this impacting our portfolios. ESG is a wonderful thing, but if it turns out that all of our companies embrace ESG and are losing money as investors, we're going to be disappointed. So that's great. You're wonderful, doing a great job for the environment, but you're killing my performance. So we live in interesting times, to say the least. I'm a big believer that we should let markets solve some of these problems, but I'm not in charge. Yeah.
Some of us might be startled at the suggestion of inflation climbing to 5%, more than double by the end of the year, which of course is only about 90 days away.
Yeah.
What are the implications of that sharp of an increase in a short period of time, if any?
Yeah.
And what would cause it to come back down after it spikes?
Yeah, well, actually on a year-over-year basis, the CPI, the consumption deflator, they've been 4 to 5%, including oil, energy and food, stuff that people actually need and for travel, for getting around, and for sustaining themselves. So that's kind of been where we've been, and there are a lot of different inflation indicators that all of, some have been actually higher than that. Some of the producer price index measures, and if we get into a cold winter and we start to see that we are seeing our natural gas prices double, and that affects not just the cost of heating and electricity. It affects it's an input in manufacturing in a lot of industries. So I think what your question is very relevant, because I think we're going to get into the last few months of this year, early next year, we're going to get, like November, December kind of numbers for inflation. And I think it is going to raise some concerns that this inflation is not as transitory as Fed Chair Powell said it might be, and it's more persistent. And I think so. And we look at some of the inflationary expectations surveys, they're 4 or 5% for the next year, and then they kind of moderate after that. But the bond market, I think was basically rigged by the Fed buying $120 billion per month in stocks and they haven't bought stocks yet. The bond market was rigged by them buying treasuries and agencies. And some of that 120 billion wound up boosting demand deposits at commercial banks that really didn't have any loan demand because it's been so easy to borrow in the capital markets. And so commercial banks have amplified that effect on the bond market by buying bonds and agencies. But it looks like even before the Fed started to taper, just the increasing belief that they are going to start tapering in November seems to have gotten my friends, the bond vigilantes, back. I don't know if, back in 1983, I coined that phrase, the bond vigilantes. I have a feeling that if it keeps going like this, I'll be getting calls from accounts and the media about the bond vigilantes back.
Mark, do we have time for one more?
Yeah, we got one more.
Ed, in your piece today, you highlighted a skills issue you ran into when you were in Cincinnati. And it's one of the issues that's on people's minds, but it's a great story. So if you could just share that and we'll wrap up with that one. And thanks very much for joining us today.
Yeah, sure. No, I had a great visit in Cincinnati. I stayed at an upscale hotel downtown, and I flew in early in the morning, so I landed in time for breakfast. And I was really in the mood for a really kind of a good breakfast. So I sat down. It was a nice breakfast room, and the waitress came up, and there was nothing on the table. And she said, would you, here's a menu, would you like coffee? I said, sure. So she brought me the coffee, and then, before I knew it, she kind of went off. And then I finally caught her attention again. I said, I need milk, I need sugar, and I need a spoon. And she brought them all separately. She screwed up my order, but I didn't say anything to anybody. I mean, that's, it's the nature of traveling these days. My wife and I went to Nashville to overcome some of our cabin fever like 2 months ago. We went into the Grand Hyatt and walked up to the reception, and the reception said, "Oh, so you're here for 2 nights?" I said, "Yep." She said, "Well, if you want any towels or sheets, just call housekeeping and somebody will bring it to you." So, I can't think of a better way to increase productivity in the whole hotel business than to have the customers make their own beds. So, that's the world we live in right now.
Thanks very much, Ed.
Thank you.
Thank you, Ed. Thank you, Stephen.
Anybody who
Brad.
wants to sign up for a trial, just go to our website, yardeni.com, and give it a try. Thank you so much, everybody.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.